Good morning, everyone. I'm Martha Stokes, and today I want to talk about the market participant cycle. There are many different market participants in the market cycle, and this is LRXC. Lam Research is a great one to study because we have a bottom formation here, and this trend will go up. And we can see over time that this is working and that it gives you the sense of what I'm trying to teach you today so that you can understand what's going on. All bottoms are formed by the dark pools, the buy side giant institutions. They see the opportunity, they see a bargain price, they also see that the company is starting to turn things around after a bear business cycle. All companies have their cycles of bear to new research, new technologies, market growth and market saturation, market decline, and so on. There's a cycle for the stock market and there's a cycle for the business itself. And this is important to understand because all companies go through this. And if you understand the cycle of market participants, how the stock market functions and reacts to the different information that's coming from corporations, then you will be better prepared to take advantage of the opportunities that present themselves in the charts sooner, and you won't have to rely on someone else, a recommendation or whatever, and be in a stock that may not be right for you. Now, why isn't every stock right for you? Well, you're an individual, and there hasn't been a single student in 27 years that was the same as another student. There's similarities, but there's differences. Your risk tolerance, your capital, how much experience you have, what knowledge you have in what industries, or what was your job or is your job, and how does that help you understand that business? Because each company is a business, and if you understand that business, and the business of businesses is the stock market, you will be able to better choose a stock that's more conducive for you, has the risk that you can tolerate, has the potential that you want, and is tradable so that you don't suddenly panic if there's a little tiny black candle that forms one day and you think, oh no, it's going to go down, because you don't understand the cycle. So you want to learn the cycle. The bottoms are always buy-side institutions called dark pools. They hunt for bargain price companies. They hunt for companies that are turning things around and improving things. And we have a plethora of companies that have been turning things around this year after some declines in previous years. So this is the realm of the dark pools. They build the bottom and they creep it up. As you go up the cycle of market participants, you also have wealthy investors who understand business. Most of these are men and women who ran a company, a CEO, and ran a big company, and they are now wealthy and retired, and they have someone manage their money for them. But they also tell that money manager what they want them to buy. So these wealthy investors also get in here, but they are inconsequential because their activity is so hidden. But they are out there and they are monitoring, and they are also buying a lot of startups and things like that because they know that new technology is where the stock market is always concentrated. The growth of the stock market is always concentrated in the new technologies, and we have more than 20 new technologies coming to market in the next decade, and it's going to be a staggering bull market. So you want to be prepared for it. We also have sell-side institutions that get in wherever they need. They will either be doing buybacks for big corporations, and 486 of the S&P 500 are all doing buybacks right now because they have a lot of cash on hand because the government lowered the tax rates for corporations, and so they have lots of cash. So they're using that cash for a lot of things. Then we have the professional traders. There's sell-side floor traders from the sell side, the big money center banks. There are professional buy-side traders who trade on a floor for the giant pension fund or mutual fund that is private. All the big dark pool companies are privates. Yeah. So they don't have the constraints that a public company has, and that's why they do it. Then we have independent traders, professional traders who once were on the floors. and they decided to go independently. And the newest member of this side of the market is the independent professional trading company. The independent professional trading company provides the same services as the banks. They can do buybacks, or they can help boost the dark pool's return on investment, because they buy-side institutions know that their long-term investors, their 401ks, IRAs, and all of that will hold and will not panic so long as the return on investment is within the percentage that they have been promised, and so they will often boost their price with short-term trading. So the return on investment is continually um, moved up and held so that there's no panic in the market, even if the world looks like it's coming to an end. There's a lot of consolidation here, and the dark pools are also in that. I can tell that from the way this is going, and that is what's going to work very well. And then we have again corporations. Corporations invest in the market in a variety of ways. They are particularly interested in startups. Then we have high frequency traders, and high frequency traders can happen anywhere. Anytime there's a gap up or down at market open, it is the HFTs and hedge funds filling orders on the millisecond scale, a second or two before the market opens. The computers of the market then see all these small lot orders because they're all small lots. It's the quantity of orders that causes the gap down, not the size of the order. And that's very important for you to understand. A lot of people get confused. A lot of traders are confused and they think, well, it has to be a large lot for them to gap it down. No, it's exactly the opposite. It is a very small number, a small 100, 200 shares, but there are thousands of those orders. So when those orders come in, and HFTs and hedge funds can cancel them in a millisecond if they need to. So there's no real risk there. So they causes the gap downs. Lam Research doesn't have gap downs, which is very interesting. It's been going along and trucking up, had a good earnings report, and was doing very well. So as we move up the scale, then the news, retail news says, oh, small funds and small management companies and AAII, investment groups, and all of those, look, this stock is moving up. They tell you about right in here. Okay. This is when they say, oh, you should buy the stock. And we can see these little gap ups that are caused by the HFTs gapping it up because of the news. That's the retail news. So that's on the retail side. 80% of the activity that happens down here where you're missing out on because you don't know how to read the charts yet and you haven't become accustomed to going, okay, who's controlling price? Okay, why are they controlling price? What's going on here? Why did this gap occur? You have to think in a different frame, and always who's controlling price where. So the dark pools and the professional side control 80% of all the market activity every single day. And this can be a day, a week, a month, a year, whatever. It's always the same cycle over and over and over again. So as you get used to this and you go, oh, okay, this is when the pro traders are going to nudge this. It goes down a little bit because some smaller funds think that it's going to collapse again, but it isn't. These are just minor corrections. And then we get the news that it's going to be better, and then it shifts sideways again because we ran out of buyers. Okay. So retail really wasn't in. They're really nervous in February and March. And so they were kind of holding back. So buy side continued to buy a little bit more. It ran down a little bit. They're not worried about it. They're holding it long term. Then it's moving up. And then we have another gap up, and we had a big movement up because it has had a good earnings report and a little earnings run on it, but not a big one. This is an important company. And retail groups and retail investors, memes groups, trading chat groups, and all of those, and then the odd lotter always get in when the vertical angle of ascent is too steep. This is not too steep yet. The stock has been going sideways, absorbing the any kind of speculation. It patterns it out, allows the fundamentals to meet this value. Then it goes up with speculation again, and then it patterns out again. So all these sideways trends are beneficial. They also provide all the support you could possibly need for swing trading. And you can put some support levels right up in here. And this stock is going to continue to move up. Why? Well, it's in semiconductor equipment and materials, and there are 5 new materials coming out in the materials part of semiconductor equipment. So it's going to be a strong growth. Now, I read the news this morning and they're going, oh, the news says that everything's going to be awful and it's going to be a disaster, and corporations are spending too much money on investments. It's like, what do you want them to do with their money? Go play golf? You want them to invest in their company. If they're investing their cash in the company, that means they know it's going to grow. So don't listen to the news. Try to understand. I had to do this really quickly and my time is out, but the market of participant cycles is very important, and you need to learn and understand who's in control of price all the way up and when it becomes speculative. So you need to be more conscious of how you exit with professionals rather than against them. I'm Martha Stokes, and that's my topic for the day.